Patrick Waddell here. I am the Chief Investment Officer at RFG Advisory in Birmingham, and I wanted to come to you today with a little bit of commentary on inflation and interest rates. One of the number one concerns that I get out of clients here in the past couple of weeks is just this notion of interest rates are moving higher, inflation is going to move higher, and I am scared about the overall value of my portfolio. I'm afraid. An overarching commentary before we get into inflation and interest rates is just about the value of television shows like CNBC and Fox Business and whatever else that always want to have something to talk about. We should always keep in mind when we watch those programs that the real reason why they want to talk about these things is to get you to tune in. And it's very easy to scare you into tuning in. So just like the nightly news doesn't report a whole lot of feel-good stories, the CNBC and Fox Business and all of their ilk are generally not incentivized to tell you about positive things that are happening. They're incentivized to tell you about negative things that are happening because if you think everything's good, you'll probably just turn off the TV and go play golf or go cook something for your kids or go do something else fun and interesting and not be panicked about the markets. Inflation and interest rates are going to move higher. And that does impact prices of things. Obviously, inflation, as inflation goes higher, the stuff gets more expensive. As interest rates get higher, stuff gets more expensive in terms of interest rate, in terms of borrowing, auto loans, mortgages, all of that kind of fun stuff. We spent a little bit of time in one of our recent market updates talking about how higher interest rates generally impact the stock market in somewhat of a negative way. As interest rates move higher, the stock market may see a substitution effect into fixed income, or it may see discount rates raise, which lowers equity multiples. However, the important thing to realize for both inflation and interest rates is that nothing in economics happens in a vacuum. A lot of people are led into this trap where they sort of think about, okay, interest rates are rising and that must be bad. Because if interest rates rise in a complete vacuum, then there are negative knock-on effects for equities. However, I think always the more important question to ask is, well, what's causing interest rates to rise? What is causing commodities to rise? What is causing oil prices to move up above $60 for the first time in recent memory? What is causing, copper and the rest of the commodities complex? What is driving all of this? And the answer in this case is growth in underlying economic activity. So people are driving more, we're using more energy. The economy is sort of waking up out of its slumber. As of the fourth quarter, we were still about 10% lower in terms of overall economic activity than we were in the fourth quarter of 19. The economy has a long way to go to sort of roar back to life, if you will. And as that economy roars back to life, we are going to see some inflation. We're going to see some rising interest rates. We're going to see some other things like that. That's not a bad thing. It is a side effect of getting our economy moving again. And while it may have some short-term negative impacts, the longer-term impact of what's causing it is decidedly a positive thing. So, I hope that puts to bed a little concern and maybe gives you a little bit of comfort that, so long as what we're seeing in the treasury markets and what we're seeing in inflation markets is really being driven by underlying economic growth, it's not something that really keeps me awake at night. If there are any questions about this or any topic, really at any time, please feel free to reach out to your advisor or to myself. I hope you're having a great week, and I look forward to talking to you again soon.